Hello and welcome. I'm the economics dude, and today we'll be discussing trade protectionism, particularly tariffs on foreign companies on the domestic economy. But first, let's consider a scene between Boeing and the US government. This is a scene where trade protectionism really is very common.
Thank you for meeting me, Mr. Congressman. I'm the CEO of Boeing, as you know, and we need some help because Airbus are selling a lot of their products at cheaper prices funded by the European Union. We really need some help in order to compete against them. No problem. Thank you for coming. And we definitely also see it as a priority to protect your industry against Airbus. But formality says that we definitely need to explore exactly why you need protection against foreign industries. Typically, we would offer you either a tariff or a quota or a subsidy. A tariff or quota on the actual foreign good or a subsidy to your company. Typically, we think a tariff might be suitable in this case. But formality says we must know exactly what are your reasons for protectionism. So far we have here protecting infant industries, protecting jobs in domestic industries, revenue, national security, protecting consumers against unsafe products, discouraging unethical and unsafe practices, narrowing the budget of payments deficit, the balance of payments deficit, or cultural preservation. So which of those reasons do you think that you deserve to have protection against Airbus? Well, the answer is simple. Protection of U.S. jobs, protection of domestic industry, and also it would improve your trade balance because, as we know, U.S. is in a lot of debt. So if you help me, we'll definitely help you.
Okay. In that case, I think a tariff might best suit you in this situation.
That is correct. That is correct. You don't actually look much like a congressman, I must say.
Well, yeah, I understand that, yeah. But I just came back from the golf course, so excuse that I'm not exactly fully suited up right now. But in the end, it'd be pretty stupid for me to play a congressman, just like it'd be very stupid for you to just play a CEO, wouldn't it?
Well, thank you very much, and I look forward to that. Sorry to interrupt. I'm the CEO of Airbus, and I had an appointment earlier, but I've been very, very late, caught in traffic. I'll just take a seat. So, what have you guys been talking about? Oh, no, you missed nothing, No, we're just talking about nothing. We're talking about baseball, yes, yeah, big game, bottom of the ninth, big swing, Yankees, Red Sox won, Yankees suck. And what else were we talking about? We were talking about my mother-in-law. She's a lady. She lives with my wife. Like big lady. And yeah, what a man.
Now we may illustrate the effects of tariffs on the domestic market. So let us assume that we have a basic demand and supply diagram with price on the y-axis and quantity demanded on the x-axis. If we have equilibrium at point E, this would mean we have a no trade equilibrium, where essentially all domestic demand is met through domestic supply. However, when you have foreign companies actually selling their products on the domestic market, this means a overall lower price, where there's more competition on the domestic market. This means that we have different intersections of the demand and supply curve, where we have QS1, which is the quantity supplied on the supply curve. Then we have QD1, which is the quantity demanded on the demand curve. And as we can see right here, we have a higher demanded quantity than we have a supplied quantity. So this overall space is then filled up through imports. And we call this area I1 for imports 1. So these imports are then used to fill up the gap in the deficit between demand and supply. Now say the government wants to impose tariffs to protect the domestic industry. This would mean a rise of prices from P1 to P2, where a tax or a fee is levied on the foreign company. So this added price of P2 would mean a different intersection on the demand and supply curve than from P1. This means that we have more of a quantity supplied, but less of a quantity demanded. And so whereas before we had imports given by I1, now we have a smaller value of imports than we had before. So this is going between QD2 and QS2. This is given by I2. Now we consider the overall gains and losses from tariffs. So particularly we want to know what are the state income gains and losses, the producer surplus, and the consumer surplus. The state income is given by the amount given to the state from these added fees or taxes. This is given by this rectangle right here, to which we call C. So we say state income is equal to C. Producers gain a producer surplus because now they're able to produce more, supply more to the economy. This is given by the area of P1 to P2 towards the supply line. So this area towards the axes is given by area D. So we say that area D is given by the producer surplus. However, consumers would lose out from the added prices given on the domestic market because they have to pay a lot more. This is given by the entire area towards the demand curve, including the two triangles that we did not consider before. So calling this triangle A and this triangle B, we have a total loss of A, B, C, and D on consumer surplus. So finally, what is the overall welfare gain or the total welfare loss from these tariffs? We do this through adding together the state income, the producer surplus, and the consumer surplus. This is given by the value TW for the total welfare gain or the total welfare loss, which is areas C and D, which are added through state income and producer surplus. However, we lose areas A, B, C, and D through a loss in consumer surplus. This overall gives us what is called the deadweight loss, which is given by the triangles A and B. This is the overall loss to the domestic economy because consumers have to pay more of a loss than what is gained through producers and through the state. So overall, we can see that tariffs might be more harmful to the economy, but they are very, very useful to producers domestically who want to compete against foreign companies. It is also very good for the state who wants to either raise revenue or to protect domestic industries or the national security or any other range of factors as to why we use protectionism. And that is an explanation on tariffs. An explanation on quotas or on subsidies can come in a future video. So until then, I'm the Economics Dude. You've been awesome. See ya.